Are you ready to discover a pharmaceutical stock that is absolutely skyrocketing? Or could a hidden cash trap catch you completely off guard? Today, we are diving deep into the institutional earnings breakdown for Q4 fiscal year 2026 for SENORES Pharmaceuticals. We will see behind their staggering 143% EBITDA surge, and we are unpacking exactly how this hyper-growth engine works. To give you the complete picture, we are tracking 4 critical areas today. First, we will decode the headline numbers behind the massive Q4 profit surge. Second, we will look under the hood of the growth engine to see why regulated markets drive 64% of their volume. Third, we will solve the cash flow paradox, reconciling record profits with negative free cash flow. Finally, we will analyze the risks and valuation to see if this stock is truly priced for perfection.
Looking at the fourth quarter at a glance, SENORES has delivered what can only be described as a structural breakout. Total revenue reached 189.70 crore rupees, marking an impressive 57.8% year-over-year increase. EBITDA surged an explosive 143.6% to 61.94 crore rupees, while profit after tax, or PAT, jumped 104.6% to 36.67 crore rupees. This operational scaling, particularly in North America, pushed their EBITDA margin up by a whopping 1,151 basis points to 32.65%, turning high volume into explosive bottom-line profitability. When you look at the visual data comparing their 57.87% revenue expansion against their 143.67% EBITDA growth, the explosive operating leverage becomes crystal clear. Profits are scaling significantly faster than the actual revenue base. The revenue growth is being driven heavily by regulated territories and new hospital launches, while their internal efficiency proves that overhead scaling is highly optimized. The ultimate takeaway here is that SENORES isn't just selling more units, they are retaining vastly more profit per single unit sold. Let's break down their revenue by geography to see where the money is actually coming from. Regulated markets, specifically the US and North America, are the absolute core engine, accounting for 64% of total volume at 427.40 crore rupees, growing 83% year-over-year with high 39% operating margins. Emerging markets make up 22% at 145 crore rupees, expanding across more than 40 countries and turning entirely cash flow positive. Meanwhile, API and other segments contribute 8% at 51.60 crore rupees, and branded generics represent 6% at 40 crore rupees, standing out as the fastest growing segment with a 135% year-over-year increase through Indian hospital listings. The future revenue output looks incredibly secure thanks to an embedded ANDA pipeline that guarantees capital-efficient growth. While their current baseline sits at 51 approved ANDAs, the real hidden catalyst is an activation pipeline of 30 approved molecules that are pending launch into the market. This provides a highly capital-efficient 12 to 24-month growth runway requiring zero additional research and development spend. On top of that, their 70% stake in the American joint venture provides a direct federal entry pathway for U.S. government and veteran medical procurement. Financially, SENORES is backing this expansion with a fortified balance sheet designed to support rapid growth and acquisitions without taking on dangerous leverage. Visually represented by a perfectly balanced scale, their net worth has climbed to 933.60 crore rupees through internal revenue accumulation, complemented by 159.61 crore rupees in cash and liquidity. With a total debt of 327.09 crore rupees, their debt-to-equity ratio sits at a very comfortable and safe 0.35 times, giving them serious acquisition firepower, as seen in their recent 75% stake in indianpharma. Now, we have to address the ultimate cash flow paradox. Why did a robust 121.53 crore rupees in profit after tax convert into a negative free cash flow of minus 202.68 crore rupees? The document visualizes this as a leaky bucket, where cash drops down to a cash flow from operations of 62.05 crore rupees, a 51% conversion. This working capital drain happened because receivable days jumped to 187 days due to rapid export scaling, tying up 324.82 crore rupees in receivables. Combine that with an aggressive capital expenditure of 264.73 crore rupees invested into their new Atlanta sterile injectables facility, and you see why free cash flow went negative, which is actually typical for a pharma operator in an intense asset creation phase.
Despite the cash drain, the company boasts exceptionally clean margins and high-quality earnings, visualized by a clean performance gauge hitting 65.05% for gross margins. This is backed by strong pricing retention and a superior product mix. Their core operating profit is structurally sound at 217.09 crore rupees, proving that the EBITDA margin expansion to 32.65% and PAT margin of 19.33% comes from pure overhead optimization rather than accounting adjustments. While the fourth quarter saw minor one-offs, including 17.67 crore rupees in other income, the core operational lines remain uncompromised.
From a valuation lens, is the stock priced for perfection, or is there a deep value opportunity? Looking through a historical lens, when it listed in late 2024 at 391 rupees per share, it had an entry price to earnings ratio of about 14.8 times. Now, looking forward, with annualized earnings per share advancing sharply to 26.39 rupees and full-year earnings growing over 97% year-over-year, the forward price to earnings to growth, or PEG ratio, sits below 0.2 times. The verdict here is clear. The recent hypergrowth provides incredibly solid mathematical support for current market multiples.
Looking at capital efficiency and return ratios, SENORES delivers a 13.01% return on equity and a 15.11% return on capital employed. These are solid, highly profitable returns on a heavily expanding equity base of 933.60 crore rupees and a total capital employed of 1,218 crore rupees. Furthermore, they maintain a massive operational buffer with a 7.35 times interest coverage ratio to easily service debt obligations, alongside an excellent short-term health profile indicated by a 1.92 times current ratio, even after deploying their IPO cash.
Evaluating their diagnostic risk matrix reveals 4 key pillars investors must watch. On the negative side, there is high working capital intensity because receivables jumped to 324 crore rupees, meaning extended credit terms are tying up cash, alongside client concentration risks in regulated markets that expose them to buying group pricing pressures. On the positive side, their clean CapEx additions are fully aligned with pipeline expansion, like the Atlanta facility, and their core earnings show no heavy reliance on one-offs, proving the growth is entirely structural.
In our final synthesis of the Q4 fiscal year 2026 data, 3 main conclusions stand out. First, the hypergrowth is entirely real, backed by genuine 32.6% EBITDA margins, not accounting tricks. Second, the future catalyst is locked in, with 30 unlaunched ANDAs providing a clear zero R&D growth runway for the next 12 to 24 months in North America. Third, while you must monitor the cash due to high working capital and 187 receivable days, the balance sheet's low debt-to-equity ratio of 3.5 times provides an ample safety cushion.
So, what is your take on SENORES Pharmaceuticals? Is it a screaming buy at a 0.2 times forward PEG ratio? Or do the 187 receivable days worry you? Drop your thoughts in the comments below. If you found this SENORES Pharma earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.